Welcome to the Real Talk Retirement Show, where we explore the financial side of retirement and beyond. Whether you're currently retired or planning for the future, we offer real, relatable conversations about money and personal finances. Most importantly, we dive into all these topics using real talk. Now, let's get real about your money and your retirement.
Welcome, friends, to another episode of the Real Talk Retirement Show. We are Brian Graff and Tracy Burke back with you as always. And as the name of the show implies, and something hopefully our loyal listeners are already well aware of, we're here to talk about all things retirement. And today we're talking about how to best invest your money as you get close to retirement. And just as importantly, what you should change once you actually retire. Most people think retirement is about hitting a number. For example, having $1 million saved up. But in reality, it's more about what happens next, how you turn that number, whatever your number may be, into a paycheck that lasts the rest of your life.
Yeah, and that's such an important concept, of course, Brian, and maybe tying in a visual. I think, a lot of times if we help visualize some certain things that might be helpful. Imagine, that obviously many people spend decades working and think of it like a mountain. As your working career climbing up that mountain. And that peak of the mountain at the very top, and I sometimes think of like comics or something like that, where they have that really sharp, pointy, top of the mountain, not the nice, curvature that goes on forever, but that,
Yep.
that real peak of the mountain is really representing your retirement. And that's of course that moment when you switch from saving to now having to take money out of your portfolio really to live in. And once you reach that peak, now you need to focus how to get down the other side of the mountain safely. So, as you're coming up to the peak of the mountain, you're thinking in cartoons like they're running fast and all of a sudden they run off the very top of the peak and
Right.
their legs are gone and they're midair and then they start coming crashing down and whatever like that. Of course, in the retirement mountain, probably as you get close to the top of that peak, maybe you start slowing down a little bit. So you're coming down cautiously, right? So your
Mhm.
feet start to really, gain traction and so forth like that. You're probably going to start slowing down as you go down that peak. And then once you're comfortable and you get there, everything's okay. But again, the prudence is probably to ease into the top of the mountain as that life changes. And again, all things we're going to explore in today's episode. So, Brian, I think you have a story that you want to kick us off with today.
I do, Tracy. We love our stories to paint a picture. So let's rewind, shall we, back to 2008. I know most of us investors would rather not, but let's do it anyway. Let's humor me, and we'll talk about a couple. I'm going to call Mike and Susan. They did everything right. They saved money for decades. They built a portfolio of about $1.8 million, paid off their house, and retired feeling confident as they should. And that's a big number they were able to save. But just a few months into retirement, the market dropped, and wow, did it ever drop?
Yeah.
Suddenly, everything felt different. Not because their plan was broken, but because for the first time they weren't contributing to their accounts anymore. They weren't saving. They were taking money out. And every headline felt heavier. Every statement they received from the custodian felt more personal. So they started asking questions like, should we go to cash? What happens if this keeps going? Are we going to be okay? Normal questions to ask.
Mm.
And that's the moment that defines retirement for a lot of people because, retirement isn't just about having enough. It's about having a plan that you can stick with when things get uncomfortable. So, again, today we're going to talk about how to invest in a way that not only works on paper, but actually works in real life.
And what you described with Mike and Susan there, that is a very, common situation, right?
Right.
And so from that financial perspective, that actual sort of moment of almost flipping the switch, so to speak, that can be really tough for many people and for many reasons and sometimes different reasons. But again, shifting from that accumulation phase to the distribution phase, and again, that's really tough for most. So if we sort of focus starting on the accumulation phase, we often have that mindset, well, how much can it grow, or can the portfolio grow? And sometimes we're often quite aggressive with our portfolios and looking for that next Apple or whatever is out there. And we're in sort of that maximizing growth phase, right?
Mhm.
Then, as I mentioned, we hit that switch and begin taking money out of the portfolio, and all of a sudden, you know, typically, as I mentioned with the that example of going up the mountain, we want to become a little bit more cautious, maybe a little bit more preservation mode, at least initially, and figure out how to most effectively create that retirement paycheck. So we often wonder, just ask ourselves the question, how do I not run out of money? Of course, that's something that, for some folks that's the number one question, or what keeps us up at night. But again, it's not usually advisable to make a quick change. And again, that visual of climbing the mountain, gradually slow down a little bit, so you don't go flying off that very top like we talked about. And then on the way down, though, you gain your footing, as I mentioned, and traction, and hopefully then you have smooth sailing and you're sort of set the rest of the way out.
Yeah, it's also important to remember, Tracy, there's often a big shift that happens here. So while you're working, mistakes can be fixed with time, maybe extra savings, future income. But once you retire, you lose
Yeah.
one of your biggest assets, which is your paycheck. And that means your portfolio really has to start doing a different job by kicking in and providing that reliable income stream. All right, so let's now talk about some key risks that can happen and affect the beginning of your retirement. What do you have for us, Tracy?
Yeah, so I would say the first one is called what we call sequence of returns
Mhm.
risk. And it basically means this, if the market drops early in your retirement while you're taking withdrawals, depending on the level of risk in your portfolio, and again, we would define that as mostly the amount of stocks versus bonds, of stocks being, of course, more risky. It can permanently damage your portfolio if, again, the stock market has a decent decline early on. And that's even true if the markets can recover later. There's a period of time. If we rewind the sequence of returns risk, it was very real for a number of people back in the great financial crisis back in 2008. Now, if you saved enough, you're in very good track to retire, you have that diversified portfolio, and I would say a reasonable asset allocation, you're likely just going to be fine. But the sequence of returns risk, sort of retiring at the wrong time, and it's tough to prevent or
Yeah.
know when, if that would happen. A couple other risks here, to just briefly discuss, is longevity risk. Some people live a heck of a long time, and some people spend 30 years or more in retirement. So
Yeah.
of course, we've talked through that before. You want to make sure your assets last through retirement. Inflation, there's period of time, and right now, as we're recording this in mid 2026, there's a little bit of a bump in inflation, and it's certainly a real thing for a lot of people. But periods of high inflation can certainly mean those dollars just don't stretch as far as they used to. And then I would say maybe the last risk that comes to mind, Brian, at this point is the behavioral risk,
Right.
right? Now, sure, none of our listeners would ever do this, but some folks tend to hit that panic button when the markets aren't doing so well, and sometimes can make some really dumb financial decisions that we've seen, right, Brian?
Yeah, human nature, right? It's not your fault. Trust me, I get it. We all tend to panic about things from time to time, but one way to kind of combat this behavioral risk is to work with a trusted advisor who will take a long-term view for you and will hopefully convince you to take that deep breath that's necessary and really think twice about making any of those emotional decisions. So it's great to have someone on the sidelines there with you, helping you
Yeah.
every step of the way.
Yep.
So now that we know what to look out for, some of those risks, we often ask ourselves the question, what adjustments should I make to my portfolio? And, we discussed potentially slowing down, of course, near the peak of that mountain, Tracy, in asset allocation terms. And if you're overly aggressive, if you've had 95% of your money in the stock market, for example, you certainly may want to begin downshifting in the years leading up to, moving into that distribution phase.
Yeah.
And this, of course, all depends on your risk tolerance, your income needs, and other unique items to you. Remember, we're not all the same, and this is something an advisor can help you determine. Some listeners out there are likely familiar with what's called target date retirement funds, which are all in one kind of options, portfolios with a predetermined mix of stocks and bonds, really for the average investor at certain age points. Most of the big fund companies have these, and they use what we call a glide path, right? Which is basically a gradual reduction of the stock exposure in your portfolio the older you get, right? Or the closer you get to that retirement date. This can make sense for lots of people, and depending on your situation, maybe it doesn't, but it is a very common strategy, that glide path approach that really enforces slowing down slowly but surely as you get closer to the peak.
Yeah. And to go along with that, we certainly do believe it's important to have a mix of stocks and bonds in your portfolio. And as you're talking about, the glide path and that mixture and becoming that, but stock exposure is important to have, especially including during the retirement standpoint. An old rule of thumb that most have heard before, and it's sort of morphed over time, but it's sort of a rule of thumb is if you take the number 110
Mhm.
and then subtract your age, often that's, sort of the middle of the road stock exposure that you have. So if your age, 105, you subtract that from 110 and maybe you should have 5% in your portfolio, right, Brian?
Yeah, yeah.
Okay.
Not quite there yet, Tracy.
Okay. All right. So diversification again important, both stock and bond exposure, and again that's because when the stock market is down, and think about it, on average that happens every third or fourth year when we look at the
Yep.
statistics. So during those downturns, you can then take distributions from the bond side. If you're predominantly in stocks, and we see that sometimes, and do you make typically more money in the stocks than you do bonds? Yes, but does that mean you should be 100% in stocks? No, for most people, right? But if you are predominantly in stocks, you just lose that flexibility and it becomes tougher, and you often end up having to sell from stocks at one of those downturns just to provide the income that you need. So, something you mentioned about, an advisor, I would say that a good advisor will have some type of a dynamic strategy, and really from, selling from those positions, depending on what's happening in the market. So when stocks are doing well, often that's where you should be selling from. When stocks are down, you should be selling from bonds. So that dynamic strategy to switch back and forth, for do-it-yourself investors, that's not such an easy thing to do, but a good advisor will be doing that. So
Yeah.
again, I would say that that's super critical, and again, that broad diversification is important for another reasons. Another strategy that comes to mind, or another approach really, is we sort of refer to as the bucket strategy, where you put a portion of your portfolio in safer assets really to cover near-term spending. For example, some folks will say, I want to have enough in cash to provide my next 2 years of income. And then for income I need between years 2 and 10, I want to put that in a bond bucket, so to speak. And anything I won't need to touch for for beyond 10 years, let's put that in a stock portfolio. So there are a lot of variations on this, but different buckets, and sometimes it makes sense and sometimes it doesn't. And generally, a diversified portfolio might have some buckets within that portfolio, and you could sort of make that argument. Well, yeah, you
Mhm.
do have 10 years of money in bonds or in cash sitting out there. So a lot of variations on it, and again, not a one size fits all.
For sure. And as we said, Tracy, it may be important for sure to shift gears as you approach retirement itself. You certainly need to do some planning around how you'll create that income in retirement. what will your withdrawal strategy be? What about Social Security? Do you plan on taking it early at 62? Do you want to wait till 70? There's not a perfect answer for everybody. You really have to explore that personally and work with your advisor in making that determination. And how will taxes affect it all?
Yeah.
So lot to think about. And that's a completely different episode because it is a lot to think about. And we'll make sure to put that on our list, Tracy, to take a deep dive at some point. Sound good?
Yeah. Yeah.
Yeah, but those first few years of retirement are extremely critical though, Tracy. And what are a few mistakes that you often see when working with your clients?
Yeah. So I would say some of the mistakes we see, one is being too aggressive and just talked about that a little bit and basically not having any or enough bonds in the portfolio. Now, as individuals, we have a lot of biases, right? And studying the psychology behind some of these, one of those biases is called a recency bias, and it's what it
Mm,
sounds like, right? What's happened more recent takes a little bit more, in terms of our brain power and so forth, and that's where our thoughts go. So, as we said, we're in mid 2026 as we're recording this. The last 3.5 years of the investment market have been really tremendous. It's been
oh yeah.
fantastic, but it won't go up forever. But again, some people are like, markets have been doing great, and that recency bias leads us to think it's going to continue being that way. But
Yeah.
it's not always going to be that way. So that's a mistake, sometimes being too aggressive. Then on
Mhm.
the flip side of that, another mistake is sort of being too conservative, right? Just the opposite, not having any or enough stocks in your portfolio, and whether it's sitting in cash waiting for that buying opportunity or
Mhm.
just scared what is going to happen in the market, that's also a mistake we'll sometimes see. Over concentration risk in just having a few positions or lack of diversification. Yeah, some of whether it's tech stocks or some AI positions or other positions over time have done really well, but you want to be diversified, and some people can be very over concentrated in just maybe 20, 30, 40, 50% or more of their portfolio is in one position. And when I say one position, like one security. A lot of people have 20, 30, 40, 50% in the S&P 500 index. That's diversified. We're talking about 20, 30, 40, 50% in Apple or Nvidia or Google or whatever the name is. Normally, that can lead to some trouble at some point. Other items, thinking through mistakes, you mentioned it a little bit before, the tax element, ignoring taxes and just how they'll impact the income stream. So trying to come up with a tax efficient and a prudent income stream, figuring out taxes is important. Healthcare costs, something else. Ignoring healthcare costs, another mistake that we'll sometimes see, and not properly planning for them. Healthcare costs a lot of money, and just need to make sure you have a good plan in place of how you're going to do that, especially as you age. And then sort of
Yeah.
wrapping this all together, it's, a mistake is not planning for any of it, right? And not having a plan. Sort of makes me think of that old Ben Franklin quote, he who fails to plan plans to fail.
So true. So true, Tracy. Yeah, the healthcare cost is a huge one, by the way. If I back up a little bit, when I talk to retirement plan participants every day, they've got this vision of, I've saved pretty well for retirement. I'm going to go out at 62 or
Yeah.
63, a few years before Medicare kicks in. And then when they go out in the open market and they look at healthcare costs, they'll call back and say, you know what, maybe I will work till 65. It's amazing how
Yeah,
often you have those conversations.
absolutely.
Yeah, but besides like reassessing and possibly adjusting your risk tolerance, which is so important, you could also consider taking slightly lower withdrawals during those very early retirement years, just in case of market downturns, or at least have the flexibility to do so. Remember, it's all
Yeah.
about being flexible. Therefore, you could enter retirement with an extra cash buffer, which really makes sense for a lot of people to protect against those market downturns.
Yeah, absolutely, Brian. And I know that we're both baseball fans, and
Oh, yeah.
along with our producer Zach, who we always want to give a shout out to.
Yeah.
He's always
Shout
behind the
out.
scenes. He is a voice for radio is apparently what that is. But
Yeah. Yeah.
it's since we're in the heart of baseball season, want to use a baseball analogy, if that's okay, Brian.
Yeah, I love it. Let's go.
Okay. So investing in retirement, it's really not about hitting home runs anymore, right? Maybe back in the days when you and I were younger and on the little league diamond or high
Mm-hmm.
school diamond, you're swinging for the fences, right? But most of us should not try to swing for the fences,
Hmm.
especially if you're properly prepared in a sense for retirement. But engaging in that consistent, disciplined approach and just making sure your money is there when you need it. So it's more about not swinging for the fences and home runs, but maybe sort of
Yeah.
more of bunts or singles and doubles, bunting the runs around and consistently putting some runs up on the board.
Which is a lost art, by the way. I love that baseball analogy, but I'd love to see more major leaguers actually take this advice. Seems like everybody's swinging for the fences these days, Tracy,
Very true.
in a baseball sense.
Yeah.
So anyway, like always, let's finish up with some action items for our listeners, and these are meant to be tangible things that you can do leading up into your retirement that may be beneficial for your situation. However, again, it bears repeating. It would certainly be worth speaking with a trusted professional before you jump into these items.
Yeah, so the first one comes to mind is asset allocation and just simply revisiting it. Asset allocation again simply means how much in stocks, typically how much in bonds, maybe cash is part of that mix as well. But just figure out what is your sweet spot and what should that approach be, especially as you get closer and into retirement. Just make sure you're not too aggressive or too conservative on the other end too. Figuring out that withdrawal strategy. We talked a little bit about that in today's episode and determine which one that you will use and just make sure you have enough to provide that desired income and which sources it's coming from. And then taxes, we talked about taxes, healthcare cost, and just overall flexibility into your spending routine, if you can do it, and just planning for those. But finally, I would just say, and this one's going to certainly sound familiar, have a plan. Don't wing it, right? This is way, way too important to wing. So you need to
Mhm.
plan for a successful retirement.
Very, very true, Tracy. Great stuff again today. And that's a wrap on episode 18 of the Real Talk Retirement Show. Please remember to reach out to us anytime with questions or comments. You can reach us at podcast@conradsiegel.com. We are here to help. We truly love to help folks out. And please do remember to share this podcast with your family, your friends, your coworkers, and give us a 5-star review if you're so inclined, and subscribe if you haven't already. So thanks so much, everyone, for staying with us on your journey to and through retirement. And we'll see you next time on the Real Talk Retirement Show.
Thank you for tuning into today's show. The Real Talk Retirement Show is created and produced by Conrad Siegel, an advisory firm that specializes in helping people prepare for retirement and beyond. If you want to learn more about our work or meet the team, you can visit conradsiegel.com. Information on this show is for educational purposes only and should not be considered personalized investment, tax, or legal advice. Before making decisions, you should consult with the appropriate professionals for advice that is specific to your situation.